If your bank charges you just $15 in monthly fees and your savings account earns a paltry 0.01% APY, you could be losing hundreds, if not thousands, of dollars every year that could instead be working for you. Imagine losing $180 annually just on fees, while inflation eats away at your meager savings, costing you real purchasing power over time. Most people don't realize these seemingly small charges and missed opportunities can amount to a staggering $50,000 to $100,000 or more in lost wealth over a lifetime, all while your bank gets richer. We're going to expose how traditional banks profit from you, and more importantly, how you can reclaim that lost wealth. Let's be clear, banks are businesses. Their primary goal is to maximize profit for their shareholders, and often that profit comes directly from the average customer. They do this through a variety of mechanisms, some obvious and some incredibly subtle, that most people overlook. Understanding these mechanisms is the first step to taking control of your financial well-being and ensuring your money works for you, not just for the bank. Think of your bank as a financial supermarket, and you need to be a savvy shopper. One of the most insidious ways banks profit is through ridiculously low interest rates on your savings accounts. The national average APY for a traditional savings account hovers around 0.01% to 0.04%. This means if you have $10,000 in savings, you'll earn a measly $1 to $4 per year. Meanwhile, inflation typically runs around 2–3%, effectively eroding your purchasing power by hundreds of dollars annually. Your money isn't growing. It's actively shrinking in real value, providing the bank with cheap capital to lend out at much higher rates. Then there are the checking account maintenance fees. Many large banks, like Chase or Bank of America, charge $10 to $15 per month for their basic checking accounts unless you meet specific criteria, like maintaining a minimum balance or setting up direct deposit. If you fail to meet these often tricky requirements, you're looking at $120 to $180 annually in fees alone. This money is pure profit for the bank, simply for holding your cash, and it quickly adds up to thousands over a decade. Overdraft fees are another major revenue stream. A simple mistake, like a $5 coffee purchase that overdraws your account, can trigger a $30 to $35 overdraft fee from your bank. Bank of America alone reported $1.1 billion in overdraft fee revenue in 2021. This practice disproportionately affects lower-income individuals and can trap people in a cycle of fees, creating a significant profit margin for banks on transactions that are often just a few dollars. It's essentially a punitive charge for a minor miscalculation. ATM fees for out-of-network withdrawals can hit you twice, once from your own bank and again from the ATM owner. A typical out-of-network ATM transaction can cost you $2.50 from your bank and another $3 from the ATM, totaling $5.50 for a single withdrawal. If you make just 2 such withdrawals a month, that's $132 annually simply to access your own money. These fees are easily avoidable if you plan ahead or use network ATMs, but they're a consistent moneymaker for banks preying on convenience. Credit cards are perhaps the most obvious profit engine. While they offer convenience, the interest rates charged on unpaid balances are astronomical. Annual percentage rates, APRs, commonly range from 18% to 25%, sometimes even higher. If you carry an average balance of $5,000 on a credit card at 20% APR, you're paying $1,000 in interest annually, which goes straight into the bank's coffers. This massive spread between what they pay you for deposits and what they charge for credit is a cornerstone of their business model. Beyond credit cards, banks profit significantly from personal loans, auto loans, and especially mortgages. While these rates are generally lower than credit cards, the sheer volume and long terms mean immense profit for the bank. For example, a 30-year mortgage at 7% on a $300,000 home means you'll pay roughly $419,000 in total, with $119,000 of that being pure interest for the bank. They're essentially renting you the money, and that rent adds up to fortunes over time. This is a powerful demonstration of how they leverage your need for capital. Another less-known revenue source is interchange fees. Whenever you swipe your debit or credit card, the merchant pays a small fee to the bank that issued your card. While this fee, typically 1% to 3%, is paid by the business, it's ultimately factored into the prices you pay for goods and services. Visa and MasterCard alone process trillions of dollars in transactions, netting banks billions in these hidden fees. It's a silent tax on every purchase, an invisible profit center for the financial institutions. Don't forget the myriad of other service charges. Wire transfer fees can range from $25 to $45 per transaction. International transaction fees on debit or credit cards often add 1% to 3% to every foreign purchase. Even ordering physical checks can cost you $20 to $30. These seemingly minor fees, often buried in fine print, contribute significantly to a bank's overall profitability. They are designed to be low enough not to deter, but frequent enough to accumulate substantial revenue for the bank, particularly from less diligent customers. Think of your bank as a sophisticated financial middleman. They take your money, which costs them next to nothing, and then lend it out to others at a significantly higher price. This difference, known as the net interest margin, is their core business model. For example, they might pay you 0.01% on your savings, but lend out that same money for a mortgage at 7% or a credit card at 20%. They're essentially arbitraging the cost of money, and you are providing the low-cost fuel for their profit engine. Your deposits don't just sit in a vault, they become the bank's capital to make more money. Through a concept called fractional reserve banking, banks are only required to hold a fraction of your deposits in reserve. The rest is free for them to lend out. So if you deposit $1,000, they might only keep $100 and lend out $900, creating new money in the process and earning interest on it. This system allows them to multiply their profits many times over with your initial deposit. The power of compound interest, often hailed as the eighth wonder of the world for investors, works just as powerfully for banks. When they lend out money, they earn interest, and then they can lend out that interest money too. This compounding effect means their profits grow exponentially over time. While your savings may be stagnating at 0.01%, their lending portfolio is churning out millions in compounded returns, demonstrating the stark contrast in how money works for them versus for you. Essentially, your money is their capital. Without customer deposits, banks couldn't fund their lending operations, nor could they generate the massive profits they do. Every dollar you keep in a low-interest checking or savings account is a dollar that contributes to their bottom line rather than your own. It's time to shift your perspective. Your deposits are a valuable asset, and you should demand more from institutions that benefit so greatly from holding them. Don't let your money be lazy. So how do you fight back? Start by moving your emergency fund and short-term savings to a high-yield savings account, or HYSA. Many online banks like Ally, Discover, or Marcus by Goldman Sachs offer APYs currently ranging from 4% to 5%. For example, $10,000 in a HYSA at 4.5% APY earns $450 per year, compared to just $1 or $2 in a traditional bank. That's hundreds of dollars directly back into your pocket, effortlessly. This simple switch can make a huge difference in your annual earnings. Consider switching to online banks or local credit unions for your checking accounts. Online banks often have significantly lower overhead, meaning they can offer accounts with no monthly fees, no minimum balance requirements, and free ATM access networks. Credit unions, being member-owned, often prioritize member benefits over shareholder profits, leading to better rates and fewer fees. For example, PenFed Credit Union offers free checking with no monthly fees and great interest rates. You can find a better financial partner out there. Implement a strict budgeting strategy to avoid fees altogether. Always know your account balances to prevent overdrafts. If your bank requires a minimum balance to waive fees, make it a priority to maintain that threshold. Setting up direct deposit if it waives fees is another easy win. Tools like Mint or YNAB can help you track your spending and balances, giving you foresight and control. A little diligence can save you hundreds of dollars in avoidable charges. Automate your savings and investments. Set up automatic transfers from your checking account to your HYSA, and even better, directly into an investment account like a Roth IRA or 401k. Even just $50 a week transferred automatically can add up to $2,600 a year, which, compounded over decades in an index fund averaging 8–10% annual returns, can grow into a substantial nest egg. Make your money move before the bank can get its hands on it, turning passive cash into active wealth-building assets. Make it a habit to review your bank statements monthly. Look for any unfamiliar charges, hidden fees, or subscriptions you no longer need. Banks can sometimes quietly introduce new fees or increase existing ones. Spotting a $5 monthly fee quickly can save you $60 a year. Many banks offer digital statements and alerts that can notify you of certain transactions or low balances, empowering you to stay vigilant. Your money is your responsibility, so be its guardian. In conclusion, traditional banks are designed to profit from your inertia and lack of financial awareness. But with a few strategic changes, you can stop them from siphoning off your hard-earned money. By choosing high-yield savings, opting for fee-free accounts, budgeting diligently, and automating your finances, you put yourself in control. Don't be a passive participant in your financial journey. Take these actionable steps today and start making your money work exclusively for you, not for your bank. Your future self will thank you for reclaiming that wealth.